Hello everyone, welcome to PMS Insights. In this edition, we present to you the highlights of the budget 2019. The Union Budget has tried to provide a direction to the government's economic and social agenda. The focus is on the economic development of India's rural and low-income households, continued commitment to economic reforms and taxation policies to achieve the stated objectives. While the intent is clear, the effectiveness will lie in its execution. Some of the immediate pressing concerns were addressed by the Finance Minister, which include opening of the capital account for foreign investors, liquidity support to the banking and finance sector, improving the tax and non-tax revenues, and impetus to the housing sector. With the macro data and high-frequency growth indicators over the last 3-4 months signaling towards a marked slowdown in consumption and tight liquidity conditions, the government has taken few steps to address the growth concerns. A one-time guarantee will be given for loss up to 10% for purchase of high-rated pool assets of financially sound NBFCs, which amount to around 1 lakh crore. Also, government have provided for recapitalization of public sector banks to the tune of 70,000 crore, which should help the PSU banks to provide for bad assets and boost the growth capital, leading to higher credit growth. The government's plan to build 1.95 crore houses is expected to provide stimulus to real estate and other allied sectors like housing, finance, building materials, and consumer discretionary. The much-needed attention in the infra space is also addressed by a planned investment of around 100 lakh crore over the 5-year period. While the proposal to increase the minimum public shareholding from 25 to 35%, which implies reducing higher promoter holding, is expected to exert downward pressure on the prices of select stocks in the near term, other measures like increasing FDI limits in the insurance, media and aviation sector, increasing statutory FPI limit is expected to increase the weight in MSCI. This may lead to higher FPI inflows in India equity market. The fiscal deficit target of 3.3% for FY20 looks a bit optimistic, as the government has budgeted for lower tax revenues while maintaining the expenditure level. While on the other hand, borrowing from external markets is expected to lower the supply of bonds in India, and this might lower the interest rates in the economy. We would like to summarize by stating that the budget has tried to address the near-term problems in the economy while at the same time being prudent. The government has refrained from being socialistic and have not announced measures to boost the consumption through short-term populist measures. We expect the government's initiatives will likely take 9 to 12 months to reflect in growth. In the near term, given broader growth slowdown, markets are likely to consolidate at current levels. Around 87% of small caps, 50% of mid caps, and around 33% of large caps have fallen more than 20% from the 52-week highs. The divergence between Nifty 50 and Nifty Midcap 100 at 13% as of June is at its historical extreme. In our view, as the earnings cycle picks up, backed by improving macro and stable government, the stock market divergence witnessed in the last 18 months is expected to get corrected, with broader markets, especially mid and small caps, expected to deliver healthy returns over the medium term. We assume India's structural growth story to be intact, with high-quality businesses expected to continue creating wealth for the investors. Thank you.